and welcome back to DukascopyTV. I'm Monica Gibson, bringing you the last of this week's Targets and Focus interviews. Today I'm joined down the line by Peter Kinsella, Currency Strategist at Commerzbank. Hello Peter. So it's been another interesting week with empirical data releases, rate decisions and political events playing on investors' minds. But how would you gauge market behaviour at present?
I would say two things. What you saw are a couple of things. Markets are trading in a broadly sort of risk-off manner this week. You can see that equities have taken a little bit of a tumble, and these sort of some of the more risky type of currencies have also taken some hits. So really, it's been a slightly risk-off move, which doesn't surprise too much in the sense that we've had a pretty decent risk rally in the last 6-7 weeks. So part of it is definitely profit-taking on the part of investors. However, there are fundamental reasons as well for actually thinking that things aren't as good as we initially thought. For a start, this week's French PMI data was quite poor, and indeed Eurozone PMI data across the board were quite poor. So this indicates that the ECB might have to actually cut rates before December or thereabouts. So this has taken a little bit of the sheen off the euro, and we've seen it fall from around 131 towards where we are now, around 129. The outlook from here, I think, is still rather bearish for the euro. I think we're going to go to around 127 in the next couple of weeks and months.
The bloc currency is trading almost unchanged in the region of 129.25, depressed by softer than expected measures of confidence in Italy and France, and a fresh record high of the Spanish unemployment. But what are your expectations for this pair?
Well, I guess two things. The first is that we were quite, as we can see, we're relatively bearish upon the euro anyway. So by definition, that would mean that sort of euro sterling will fall a little bit. Concomitant with that is obviously this, let's say, the downgrades towards numerous European banks. They weren't necessarily a surprise for us. We thought, and we thought quite a few of them would be downgraded, and indeed that's what's happened afterwards. From here, really, for euro sterling, there are two things that sort of stand out. The first is that what you saw last year was that the UK gilt market, so its own government bond market, actually kind of acted like a bit of a safe haven, and we saw sort of pretty big flows coming from the Eurozone towards the UK. The result of this was obviously a sort of a lowering of risk premium in general, such that 10-year gilts are now about 1.5% or thereabouts. This sort of enables the UK government to borrow at what are very, very reasonable levels of interest, and therefore this kind of supports the outlook for, let's say, fiscal contraction in general in the UK. So, but we're a bit more, let's say, bullish on the pound because one of the reasons, as well as what I've just alluded to, is that what you have in the UK is that you have an effectiveness of, let's say, decision-making processes, and you simply don't have that in the Eurozone. For example, if the UK Treasury want to do something, they go and they do it. They don't have to speak to 15 or 20-odd governments within the Eurozone in order to achieve some kind of consensus. So it's for these reasons that we're a little bit more bullish on the outlook for the pound against the euro. And indeed, sort of by this time next year, we think that euro sterling will be trading closer to 0.75.
S&P downgraded multiple French banks overnight, and this added to the underperformance of the euro. But how do you think it will fare against the US dollar going forward?
Well, the main reason, I guess, is we've been very bearish upon the euro for most of this year, and indeed we've been pretty correct in this view as sort of the market has moved against the euro over the course of the year. The rationale from here for a euro dollar is as follows. We think that the European Central Bank is going to print an awful lot of money, basically, in order to bring down yields of sort of peripheral nations. Now, at the same time, you can clearly see that economic data in the United States is improving. Okay, and what's important to remember here is that there's quite a big substantial difference between the monetary policy of the ECB and the monetary policy of the Fed. Once the Federal Reserve see a decent pickup in unemployment and also a decent pickup, or so let's say, if they see the first signs of inflation, they can then remove their monetary stimulus pretty quickly. Okay, it's pretty obvious that the U.S. Treasury market is still by far the most liquid government bond market in the world. So they can remove their stimulus, and indeed they can actually shrink their balance sheet by and when they want. The difference with the ECB, however, is that this is something that the ECB officials can only dream of at this stage. In particular, if you look at what the ECB is doing, they're giving more and more sort of infusions of capital towards peripheral Europe. So it's hard to say that the ECB are actually in control of their monetary policy any longer. Realistically, what this means is that the ECB, in real terms, is now a captive of the capital need of peripheral Europe. It's for that reason that we feel that over the course of next year, this is going to become increasingly obvious. And what we'll be left with sort of a steadily sort of, let's say, depreciating euro over the course of the year.
The Bank of Japan is expected to increase its own QE programme next week. What impact do you think this will have on the yen, and what is your short, mid and long-term outlook for this pair?
Sure. I mean, coming up to 1 month, we see dollar yen around 80, so pretty much where we are now at the moment. A little bit further out, so sort of 1 year from now, we're going to be looking at dollar yen in and around the 84 level. Although I'd sort of hedge that and say we might even see higher levels, so we might have to revise the forecast higher over the course of the year. The reason being is that two things. First is that the BOJ set out last year, or earlier this year, said that they wanted to, let's say, have an interim inflation target of around 1%. And with that, they've then gone and printed money in order to achieve that inflation target. As it's happened, as you can see overnight, the inflation data came out from Japan, and what we saw was that rather than having inflation, they actually had deflation on a year-on-year basis. So the expectations were for a print of minus 0.4%. We actually had a print of minus 0.3%. But irrespective of that, the trend obviously isn't where they want to be. So in order to hit that inflation target, they're going to have to engage in further quantitative easing policies. And as a result, we, along with the rest of the market, pretty much expect that the BOJ are going to expand their purchase program later next week.
Peter, thank you very much for your time and your predictions today. It's much appreciated. That's all from me for this trading week, but have a splendid weekend and please be sure to click back to Dukascopy on Monday. Bye for now.